What's up guys, welcome to another episode of Real Life CFA. In this series, we'll talk about all the key concepts in the CFA curriculum and their real life applications. Have you ever thought bonds are boring? I'm telling you that's not true. Today, let's talk about bonds. As always, we'll start with definition. What is a bond? A bond is a fixed income instrument that represents a loan made by an investor to a borrower. There are generally three types of bonds. First, zero coupon bond, which is a bond that does not pay coupon. Second, a fixed rate bond, which is a bond that pays a fixed coupon. Thirdly, a variable rate bond. Its coupon payment can vary based on market interest rates. Bonds can also be classified by issuers. There are mainly three types of issuers. First, governments. For example, the federal government of the United States, the state government of California, or the city of New York. Second, multilateral organizations, such as the World Bank and the IMF. Third, corporations. Corporations can be divided into two categories. One is the investment grade. Second is the high yield grade. We'll talk about those in details later in this video. There are a few key characteristics that we need to know about bonds. First is the face value. Face value is the principal of the bond. Second, the coupon rate determines how much coupon you get paid from the borrower. Thirdly, coupon dates, which are the dates that you get paid. Fourth, the maturity date is when the borrower has to pay you back the principal, which is the face value, and plus whatever interest accrued on that bond. Next, the issue price, which is the price you pay for the bond when it's first issued. 6. Yield to maturity. Yield to maturity is the return you get from holding that bond until maturity. Last but not least, yield to worst. Yield to worst is the worst possible yield that you'll get from holding that bond. This concept is useful when pricing high yield bonds. This is the bond pricing model. It's basically discounting all future cash flows that you'll get from holding the bond to maturity, back to the present. The most important key point that you'll need to understand from this formula is the relationship between interest rate and bond price. From the formula, we can see that the interest rate and the bond price are negatively correlated. When interest rate goes up, bond price falls. When interest rate falls, bond price goes up, just like this diagram. Next, let's talk about clean price and dirty price. The clean price is the price of a coupon bond, a bond that pays coupon, not including any accrued interest. Dirty price is the price that includes accrued interest. Generally speaking, bonds are quoted in clean price. How do we manage bond risks? The most commonly used metrics are duration and convexity. Duration measures the sensitivity of the price of a bond to a change in interest rate. Duration is basically the first derivative of bond price with respect to interest rate. Convexity measures the curvature or how the duration of a bond changes as the interest rate change. In other words, it's the second derivative of bond price with respect to interest rate. As we can see, duration is the slope of a point on the curve. In real life, traders use DV01 to measure dollar risk of their bond holdings. DV01 stands for dollar duration. It measures dollar change in bond price per 1 beep change in interest rate. Convexity is the curvature of the bond price curve. The higher the convexity, the less sensitive of a bond price to interest rate changes. The flatter the curve, the more sensitive the bond price to interest rate. So, what does a bond look like in real life? There are typically two types of bond products: rates and credit. Rates are bond issued by federal governments, local governments, multilateral organizations, or government-sponsored corporations. These issuers have the lowest default risks in the spectrum because they're backed by the government. Credits are bonds issued by private corporations. Based on the issuer's credit rating, it can be divided into two subcategories: investment grade and high yield. Investment grade are safer than high yield, so we can expect a lower yield from investment grade bonds. When bonds are issued, bond originators use different metrics to value the new issuance based on the type of the bond. For example, in the United States, the Treasury Department issues bonds to finance public debt through auctions, where the yield is determined by supply and demand. For other rates and credit products, bond issuers usually price the bond based on risk-free rate plus the company's specific risk premium. For example, if Apple wants to issue a 10-year bond for whatever reason, it would go to an investment bank such as Goldman Sachs or Morgan Stanley. Then the bond originators from these investment banks will price the new Apple bond at 10-year US Treasury yield plus Apple's specific risk premium, and use that bond yield to calculate the bond price. Investment banks use the same procedure for most of bond issuance for non-sovereign bond issuance. On the secondary market where these bonds are traded, although bonds are still traded in price, but they're quoted in yields. Sovereign bonds such as US Treasury are quoted in yields. Non-sovereign rate products and investment grade credits are quoted in spreads over sovereign bond yields. High yield bonds are a bit special because high yield bonds behave like equities. They're actually quoted in price, or yield to worst. Yield to worst measures the lowest possible yield that can be received on a bond that fully operates within the terms of its contract without defaulting. Because the issuers of high yield bonds are usually high growth companies. As the company grows larger, its borrowing cost tends to go down, so the company has the incentive to replace the existing bond with a cheaper one to save money. If you would like to learn more about bond trading strategies, please click the link on the top of the screen. If you have any questions on this topic, or have anything that you want us to talk about in our future videos, please leave a comment down below. If you enjoyed our videos, please subscribe and smash the like button. You can also follow us on Twitter or visit our website at www.ironhawkresearch.com. We'll be posting weekly market commentary and article about things that you might want to know in finance. Thank you very much for watching, and see you next time.